Good morning and welcome to this Thursday, August 17th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. Well, looking at futures, we do have futures green this morning, not significantly, but up is up. Dow futures up 44 points. S&P 500 futures up 14.5. NASDAQ futures up 62. On a percentage basis, NASDAQ futures actually up a little bit more, up about 0.4%, whereas the S&P is about 1/3 of 1%, and the Dow roughly 0.1%, about 1/10 of 1%. Crude oil is up 1% this morning, back above $80 a barrel. Of course, recently we took out that resistance area around $83 per barrel. Pulled back below $80, and now today we're back up above it. U.S. 10-year Treasury yield not really slowing down, up another 3 basis points today, 4.29%. Remember, 4.33% was the level that we hit back in October of 2022, and now we're only about 4 basis points away. Certainly looks like we're going to give that level a run for its money. We'll see whether or not we can get the breakout. I think short term, maybe it creates a little bit more selling if we test it. I will say I'm not going to give away part of what we're going to talk about in a little bit, but I'll just say that sentiment is suggesting that a bottom is approaching rapidly. A lot of fear crept into the market yesterday, and we're going to talk about that a little bit later in the show. Let's go ahead and talk about what happened yesterday. Dow Jones Industrial Average down 180 points. That was about 0.5 of 1%. S&P 500 down 0.75 of 1%. That was 33 points. Takes us back down to 4,400. Notice that the S&P did close below its 50-day moving average yesterday, as did the NASDAQ 100. That was down more than 1%, down 161 points, down below the 15,000 level. We haven't seen that in a little while. Mid caps down about 1%, just under 1%, 24 points. Again, under the 50-day moving average. And the IWM, the Russell 2000, the index that I've been tracking pretty closely, also dropping below price support, which was around 188, and the 50-day moving average, which was up closer to 190. We finished down about 1.2% on that small cap ETF, the IWM. And that was down $2.30, finishing at 185.84. Certainly small cap bulls looking for a reversal there. See if we can get it later today. Transports down yesterday, closed below the 50-day. I thought that looked kind of ominous and that we would probably head toward the 50-day after losing the 20-day. Negative divergence was in play on the last high. And like many of the indices, I mean, this has really been a lesson in short-term market action after you get these negative divergences to begin to appear on a lot of major indices, many of the ETFs, a lot of the industry groups, many key individual stocks. Negative divergences were everywhere probably about 4 weeks ago. And for the most part, they have reset. We've seen PPOs reset at or just below center lines. So from here, market could go anywhere. That's where I go back to my signals. Most of my signals that I use, many proprietary signals that we have here at Earnings Beats that have helped us so much over the last 4 years, still pointing higher to me. So we'll see how far the selling goes. I don't believe it's going to go far, but you do want to make sure you keep stops in play. The key, I think, from here is going to be 50-week moving averages. And those are 20-week moving averages. And with the momentum so strong on a weekly chart, that historically has been a great area of support. So we definitely want to keep that in mind. All right, moving on to the sectors. Utilities rising 0.4 of 1% yesterday. The only group, the only sector that was positive. So that was good because we came right down to key support down around 63. Utilities have been a very, very weak part of the market. A lot of that has to do with the interest rates. We've been seeing the interest rates moving up, getting close to that 4.33% high that was established in October of 2022. And anytime we've got yields going up, that's really competition for folks that would invest in utilities, because utilities are synonymous with, just paying high dividends. And most income investors look to utilities to give them some nice income in retirement. And when 10-year Treasury yields are going up, all of a sudden, when you can get 4.3%, 10 years, starts to make some of those utility dividends, which may be higher, still not as attractive, because the 10-year Treasury yield, obviously U.S. Treasuries, don't expect anyone is looking for those for the government to default. And so that's going to be your probably your better way to go from an income investing perspective. And that's, I think, what we're seeing a little bit of. I actually think if the 10-year Treasury yield gets up above 5.5%, I don't think we're going there, but that is when I would be very concerned. And I think we would start to see some pretty significant rotation out of stocks if we get that kind of move to the upside. I think what Wall Street's telling us is that we're not going to get that kind of upside, because Wall Street continues, the big firms continue to rotate into aggressive areas. We're not really seeing, outside of the normal profit taking, which comes anytime the market pulls back. Going into the last high, there was no movement, very little movement away from aggressive areas of the market. I find that to be somewhat comforting and bullish. And so I do expect that we're going to rally. The only question for me is where and when. We are in August, September. We've talked about this a lot. Historically, not a great time of the year, but it doesn't mean that, we don't go up sometimes. September's been up probably about 40 or 45% of all Septembers since 1950. So it's certainly not a slam dunk that we're going lower. I think there are times within September we want to be careful. But overall, the month, it is the worst month of the year, but it does not go down every year. And we'll see what happens. Like I said, there are some sentiment indicators right now pointing to a bottom that's approaching. So I think we need to keep an eye mostly on that. So again, utilities, the only group that was up yesterday. Of the 10 that were down, discretionary was down the most, down 1.24%. Real estate down 1.22%. I'll also point out that the discretionary group broke below its 50-day moving average. So if the 50-day moving average is your go-to, probably not liking the charts right now. I think it's obviously a technical breakdown. Anytime you lose the 50-day, it's something to consider. But I do think there are other more important areas in technical developments, sentiment indicators, and so forth that I think override what we're seeing. I think the negative divergence has told us we're going back to the 50-day. So to go slightly below it, I don't think is that big a deal. Obviously, if things escalate, then we could be looking at potentially more carnage in the short term. But again, I'll get to a chart that will have you thinking. Anyway, looking at the industry groups, apparel retail, big day yesterday, up almost 3%. That was really the only significant strength within the consumer discretionary area. We did break out short term, but we did so with a negative divergence. So be careful if this breakout doesn't hold. If you look at a longer term chart, you'll see that the apparel retail group is actually up against some pretty key longer term resistance. We're just approaching it. So there are a number of reasons why you might be a little skeptical, even though we did have a nice day yesterday on apparel retail. Meanwhile, two groups that have been, one's kind of been consolidating. The other has been downright weak. Both have negative divergences that we've been dealing with, but they've gone about it different ways. Auto is down yesterday 2.85%, and it's been mostly just selling since really mid-July. When I did my YouTube video, the Your Daily 5, this was I actually talked about Tesla, the primary component within the autos, and talked about how that stock could take a big hit because of the nasty negative divergence that was in play. Higher prices, lower PPO. We had a big run up. That can lead to some short-term selling. And we have certainly seen that. Autos now all the way back down near that 800 level, finishing yesterday at 802. Again, that was down 2.85%. And home builders. So sticking with the consumer discretionary group, home builders very weak yesterday, down 2.32%. And we've seen some news lately that hasn't been great, if I'm being honest, for the home building group. The housing starts, or building permits, both came in below expectations yesterday. We saw that housing market index come in well below expectations. I believe that was back on Tuesday. So numbers haven't been great. Of course, rates keep going higher. You would think that, hey, that's going to have an impact at some point on home construction. I think maybe we're seeing a little bit of that right now. All right, 10-year Treasury yield. So what's going on? I will say, first of all, the FOMC minutes that came out at 2 p.m. yesterday, I think, maybe spooked the market a little bit into the close. The Fed, my buddies over at the Fed, still talking about inflation. They're saying inflation risks persist, and they may have to keep hiking rates. I'd like to get a little bit more consistency out of the Fed. They seem to be pretty persistent about hiking rates. Then last month they talk about, okay, we're going to be, checking to see, we're going to be more data dependent on what we're going to do. Most of what I've seen coming out this month, they're talking about inflation persisting. I'm seeing most inflation reports that I look at really subsiding from what we saw. Maybe we're not on a path to their target 2%, but we've seen the CPI come down, the core CPI come down considerably, well over 6%, down to, I think, like 4.7% now. So it's certainly heading in the direction they want in a meaningful way. But anyway, the minutes came out. The Fed's talking about inflation persisting, and they might have to raise rates and keep raising rates. And so that obviously has the market on edge. And we're seeing the 10-year Treasury yield perhaps building in a little bit more of inflation expectation. That's what you would expect from the 10-year Treasury yield if inflation truly was a problem. I'm still skeptical about that whole argument, but I'll leave it at that for right now. Let's just see what the Fed does when it meets in September. Initial jobless claims out this morning. That came in just almost on the number, pretty close. 239,000 was the actual number. The expectation was 240,000. But the big news, the August Philadelphia Fed Manufacturing Index, which has been negative for a while. I didn't go back to look to see how many months in a row we've been negative. Last month, July was 13.5, negative 13.5. August, we were expecting minus 10, came in at plus 12. So this is a look at kind of the economic activity in the Philadelphia district, Federal Reserve District. And so all of a sudden, kind of a surprise, it turned positive versus the negative numbers that we've been seeing. So not sure, maybe that has something to do with the futures being up. I mean, futures are really not up that much, especially with the way, when we look at the charts here in a minute. We got a lot of work to do to begin to improve the short-term technical outlook. Now, I still think the long-term is very, very bullish. Short-term, hey, we've been going straight down now for 3-4 weeks. Clearly, we need to do some things on the daily chart to improve and to begin to look, more bullish there. But a breakout in the 10-year Treasury yield is going to be harder for the market to do that. Let's go ahead and look at these charts. So the S&P 500 fell down. You can see it below the 50-day moving average. It's the first time since back in March that we have traded below the 50. Now, keep in mind, the 50-day moving average is a function of price and how rapidly we go up. I mean, some people just look at the 50-day and they just look at a line. Oh, if we're below the line, then we're in trouble. If we're above the line, okay. The 50-day moving average, when you're back here, when we were first starting an uptrend, the 50-day moving average really doesn't move very fast. But once we start, really making a tear to the upside, like we did in June and July on the S&P 500, that's when the 50 goes from just kind of advancing slightly to really starting to make a move. The thing is, your move from, where were we at the end of May, close to the end of May, we were around 4,100 on the S&P 500. 2 months later, we were at 4,600. That was more than 10%. Keep in mind that the S&P 500 averages 9% a year for the last 73 years, 9% per year. We had gone up 10% in 2 months. So when you go up that rapidly, your moving averages turn up very rapidly. And so when you pull back, and the bigger your move to the upside, the more downside risk you have in the short term. And so you get a rapidly accelerating 50-day moving average, and then you get a fairly significant pullback with some profit taking. And, in these scenarios, if you go back and look in history, it's not unusual for the daily price action to go below the 50-day temporarily. I don't think it's going to last long, but I do recognize it as at least a breakdown in the daily chart. And so what I'm saying is, in order to have an uptrending market, you need price action to be above the 20-day moving average, which is above the 50-day moving average. That, to me, is like the poster child of an uptrend. Price action above the 20-day above the 50-day. And when you get that configuration, that's when we tend to make the biggest moves. So for instance, back here when we were consolidating, when we finally made the breakout through all these tops, and we finally made that breakout in June, the configuration was very bullish. I think what we're probably going to be dealing with for the next 6 weeks, we might see a little bit more downside action. I don't know. But I think sideways consolidation is going to be probably what we see over the next 6 weeks. And I think as we go into the fourth quarter, when we make this breakout, I think what you'll see is the price action back above the 20, back above which is above the 50. And at that point, I think that's when the market takes its next big move. I don't think you never can rule out what the market's going to do in the short term. I'm very bullish. I think the market's going higher. Could it just shoot back up from here? It could. It's not what I'm expecting. I mean, everything is about odds, right? You can't say with any guarantee what the stock market's going to do. We have no idea for sure. But when I look at the charts, I look at all my signals, I come up with odds. For me to think that this is just going to go straight back up through 4,600 from here, like within the next few weeks, the odds of that, I would probably place it maybe 20% or less. I don't think that's the way this is going to play out. Now, do I think we're going to do more consolidation? And could we go back up and maybe get close to 45, 50, maybe even close to 4,600? I'd probably put, maybe a 35% chance on that. I don't know that we get all the way back up there. I think we probably go a little lower. I feel like we need to capitulate. And I think we're getting close to that. I'm going to talk about that with my sentiment chart here in a minute. But short of capitulation, I think what we'll probably see is more of the sideways action. Maybe we just kind of, back here in April and May, I mean, this is something that we could look at as maybe a blueprint for maybe what we could expect over the next 6 weeks. I wouldn't be surprised to see a bounce at some point, the low marking a pretty significant low, and then moving sideways, kind of like we did in April and May before breaking out. I think that would be the higher probability for me. Now, is there a chance we just keep going down and we morph back into the bear market? Yeah, it's possible. I'd certainly put a chance on it. But it would, for me, based on all the signals I'm looking at, I would have it as less than 10%. I don't see it happening. But yeah, there's a chance. There's always a chance. NASDAQ 100. So here again, trading below the 50. Notice as we've been bouncing, the last few bounces, couple bounces, we failed at the 20-day. So right now we're trending below the 20-day. The 20-day is coming down. Looks like it's about to cross back below the 50-day, which would be the first time. This would be a death cross on the NASDAQ 100 for the first time since we crossed back above it in late January. We've had the 20-day above the 50. But again, keep in mind the short term, the 20-day is beginning to react to this movement to the downside because it's a much shorter moving average. The 50-day is slowing its pace to the upside, but it's still going up because of it's still reacting to this huge move that we saw in May, June, July. So I think, in this situation, we're probably going to get this cross. I mean, even if we start to bounce back up, I think the 20-day keeps coming down, 50-day keeps going up. I think the cross is almost inevitable unless we just, in the next few days, just rapidly shoot back up to 16,000, which I don't think is going to happen. So I think we're going to be in this sideways scenario for a little while, and then we go from there. Now, the small caps. So for me, the small caps lost price support. And so I'm in the small caps, but I've gotten out of leverage. And I may work my way back in it. I need to see some action. I need to see something more positive. Honestly, what I'd really like to see is an intraday move that scares a lot of folks, and then with a significant recovery in the afternoon. Kind of like when we were going down here and we had this intraday move, looked like we were going to go all the way back down to this support level, and then boom, big recovery, hammer prints, and we're back off to the races. Something like that. This hammer right here goes down to test the price support from 6 weeks earlier, but it holds it, comes back up. There's the hammer. Then you make that big move back to the upside. That's what I'm looking at. Most bottoms, I'm not going to say every bottom. If you go back here, this bottom formed with a breakdown and a close near the low. And then all of a sudden we're back off to the races. So we've got futures up today. Could we move up and then just keep going up? Sure, it's possible. I mean, I got a lot of signals that tells me that we're going back to the upside. So how we go back up there, I'm not sure, but I do think we're going to go back to the upside. I would say that the way that I'd feel the best about the technicals, even with a gap up today, even if we gap up, I'd like to see at least one more low, just because that triggers more sellers. I mean, if you're moving to new lows over the past, 3-4 weeks, that will trigger another group of sellers. And so I always like to see that in forming a bottom. And then, of course, we would need the recovery after that. So I think right now it's cautious mode on the IWM, which means I don't want to be in any leverage. But if we get that reversal, at some point I would be back into the TNA. I don't want to wish anything horrible on the market, but a nice long tail anywhere close to 180 at this point. I mean, and that was my fear holding on to the TNA was if you break down below 188, I mean, looking on the daily chart, I see no support until 180. Now, it is a little bit different if you look at the weekly chart. Weekly chart, we're there. And, I hesitated yesterday because I'm like, do I really want to get out as we're testing the weekly? But this is the problem that you get into, and this is how your losses can really begin to escalate. I liked the TNA down to the 20-day, and then we had the gap down below the 20-day. And when I saw that, I was like, well, now I'm almost as close to my gap and price support to the downside as I am to where I was going to put the stop in. And so, you start to have to reassess reward to risk. And so I decided at that point to hold on. That takes me to the next gap support level, which I think was 189.80 or something like that. Went through that. Of course, I was watching price support around 188.30 and using 188 as a closing stop. We went below that. Now we're looking at the 20-week moving average, which is 185 and change. And then we've got that next support on the daily chart, which is at 180. And next thing you know, if you keep doing this, and then you get down to 180, and then you say, well, this top right here is about 178.80. Let's give it a little bit more room. Oh, then we got gap support, 177.50. Oh, the bottom of gap support, 176. Well, then you got the next lows, 17. It just goes on and on and on. I think you have to pick your spots, especially with leverage. We did pretty well on the move to the upside. A lot of the ETFs, a lot of the leveraged ETFs did very well for us. So it's just been this little blip here as we got back down to the 20-day moving average. Since then, this has been the kind of the issue we've had to deal with. And I would have been out probably on that 20-day failure at the 20-day if we didn't have this gap down. But after gapping down and, they were looking back, hindsight's 2020. I mean, you went back up, we tested the 20 and we failed. Maybe that should have been the sign that, hey, we probably got some more downside. Well, I mean, it's all in the past now. But anyway, I do like the TNA. It's just, I need to see, I don't want to be in as it's closing at the new lows 2 days in a row. This could escalate and we could capitulate. And I'll show you that in 1 second. Transports. Here we lost the 20-day. There's your slight negative divergence. Prices going up. You can see that PPO starting to roll over. Now we're getting the 50-day test. and that center line reset. That's what I look for when we get negative divergences. And by the way, we could probably look at a lot of charts. I don't know. There's Apple, higher prices, lower PPO. Right now it's trending down, but it went back down at least to the 50-day. In this case, it's actually gone down below, continues to trend down. I haven't looked at options, and we haven't really talked much about options expiration this week. And the reason I haven't is because prices have come back down, and many stocks and indexes and ETFs are close to their max pain points. So market makers really don't have a reason to manipulate, except that as prices keep going down, we actually could see some manipulation back to the upside, just to wipe out some of the in-the-money puts that have been created from all this selling over the last few weeks. Anyway, normally we're seeing the market go up, and we're talking about the market makers manipulating prices downward. If anything, as of last Friday, I think the QQQ was right at about on its max pain level. S&P, I think, was just slightly above it. Well, now with the selling we've seen this week, I actually think we could have a little bit of net in the money put premium as we go into these next couple of days and into early next week. So if you're looking for that normal 19th to 25th weakness that we generally have seen since 1950, you go back, throughout all the months over the last 73 years, worst time of the month by far is the 19th to the 25th. I'm not sure that this month is set up like the others. I'm not so sure that we'll get a decline based on options expiring because, again, I don't see a whole lot of net in the money call premium. All right, moving on. Chart of the day. This is kind of big. We're getting close to 9:30, but I want to get through this. First of all, if you like the charts of the day, always want to invite you, everyone out there on YouTube. First of all, thank you so much for joining our YouTube stream. If you like it, make sure you like our video and also subscribe to our channel. We'd love for you to subscribe to the channel. It helps us and it'll help you. Anytime we come out, we do a live event on YouTube. If you are subscribed and you turn your notifications on, anytime we go live, you'll be notified. So you want to make sure you do that because we do some live free events from time to time. Anyhow, for our EB Digest, go to our website, which is www.earningsbeats, both plural, earningsbeats.com. Scroll down, name and an email address, all it takes. There's no credit card required. It's completely free. You can unsubscribe at any time, no questions asked. 3 times a week, we send this out, Monday, Wednesday, Friday, just talking about concepts, strategies. I like to talk a lot about earnings. Obviously, that's what we do. Relative strength is big, candlesticks, price volume, all of that. Trend lines, sentiment, which is what I'm going to talk about in 1 second. All of those things. Make sure you sign up. We also do free events from time to time. And if they're not live streamed on YouTube, but you still want to attend like a Zoom webinar, if you're a subscriber to this free newsletter, then you'll get an invite to our room. We'll give you room instructions. All right. So let's look at this 5-day moving average of the equity only put call ratio. Listen, when I talked in June about the market potentially topping, one of the things I talked about was the fact that we saw the 5-day moving average of the equity only put call ratio drop to its lowest level in over a year. Now, what that tells us is that it's a ratio of calls to puts or puts to calls. So it's the equity only put call ratio, puts on top of the fraction, calls on the bottom. And so when that number gets lower, when that fraction gets lower and lower and lower, it means that there are not nearly as many puts being bought as calls. So in the case of 0.5, it's like 1/2. So 1 put being bought for every 2 calls. When you're 1.0 on this, it's even 1 put for 1 call. The put call ratio is a great sentiment indicator. I mean, I think it is the best. And the reason that it's so powerful is that it tells you what the retail traders are doing. And remember, when the retail traders all get together in a mass and move in the same direction, market makers are on the other side. Who's going to win? The retail traders who are just throwing money, caution into the wind, or the market makers who always win? Well, I just gave you the answer. Market makers are going to win. So everybody was starting to bet more and more heavily on calls as we were going up. We had this huge move. I just talked about it. May, June, July, straight up, more than 10% on the S&P. Well, that took its toll. And traders, retail traders, like to chase. And this indicator tells you when they've been chasing a little too much. There you go. What did we do? We topped. Well, look at where we are now. I was really concerned when I saw this. I mean, I actually thought, okay, I almost wish I hadn't gotten out of the TNA, because the put call ratio yesterday was 1.03. I'm going to come back to this, but let me just show you a daily reading of 1. The last time we had a daily reading above 1 was March of this year. The last time before that we had, well, actually, I'm not sure if this was still part of all these crazy readings. I ignore all these. I've talked about it in the past. I'm not going to spend any time on it today, but these were false readings. These were not giving us clear readings of what retail traders were doing. And so I have an adjusted equity only put call chart that I can show some other time that evens this out and gets rid of these huge spikes. Let me just tell you that this was a very significantly bearish day in the options world. In other words, everybody is getting into the puts. Well, this move now over the last, 5-6 weeks has resulted in the 5-day moving average moving from 0.48 to 0.80. Now, if you followed me for a while, you know what 0.80 means on a 5-day moving average of the put call ratio. It means we could see a reversal at any time, and probably a big one. If you go back and you look, and again, ignore what was going on at the end of last year, these readings were out of control. But 0.85, if you go beyond that, I'm going back 10 years here. And some of this was during big moves to the upside in the market, like from 2016 all the way through 2019. Those 4 years, that was mostly an uptrend. We had the cyclical bear market, the trade war at the end of 2018, a little bit of weakness beginning of 2018, but for the most part, we were going up. Anytime the market got fearful, look at these 5-day spikes. Now, we got up to 0.90 in the bear market. That marked the bottom, by the way. But here was 0.77 at one of these bottoms. Here was 0.76 right there right here. Actually, this probably could annotate, make it a little easier. All right. So there is your spike to 0.85, right at the bottom. There was a spike to 0.77, right at this bottom. Now, granted, I'm saying these are short-term signals. So we spiked right up. Here was slightly above 70, 0.72 maybe. We had a little pop there. Right here, just above 0.75, marked the bottom. Here we got to just over 0.80. Look at what happened after that. Here was 0.74. Where'd the market go? Up. Here was 0.80. We were drifting lower, rolling over. All of a sudden, boom. Let's see, right? All right. What the heck? So right about there. That was at 0.85. Move up. I mean, I can go and show you every one of these spikes. So look at where we are right now, 0.80. I mean, decide for yourself. I think we could see a spike at any time. What I would love to see is capitulation. One more down day, maybe, with a reversal. I think that's going to give us a better clue. It may not happen that way, I hope it does. But if it doesn't, still know that we are at 0.80 right now. And this, over the long term, I'm talking about going back all the way throughout this century, that has been a very significant bottoming indicator. And we're there again. Anyway, see what the market's doing, see if we've rallied. Seeing a little bit of rally in the small caps, a little bit more than the others, but 0.25% up, close to 0.5%. VIX is a little bit elevated, still up near 17. I think if we get one more pullback, if the 10-year Treasury yield could maybe pop today, get through 433, market break to new lows, VIX go through 17, we could have a perfect storm for a short-term capitulation. And we'll see whether or not that materializes. Anyway, that's it for me. Next show will be on Tuesday. Next Tuesday, that'll be what, the 22nd of August. So I will see you then. Take care. I'll be watching this. I'll make sure whatever I see, I'll be passing along in the daily market report. Excuse me, for all of our members. So be on the lookout for that. I am traveling today. I don't know when the DMR will come out, but I will have my eyes peeled on the market throughout the day. Anyway, everybody have a great day and happy trading.